Okay, so welcome back with another TCon video. This is TCon on foreign exchange and balance of payments accounting. In this video, we will get a chance to understand a little bit more about the current and financial accounts and how those work, and the foreign exchange graphs, causes of shifts on those graphs. We'll learn about currency appreciation and depreciation and its effects on the macroeconomy. And we'll do a little bit of practice FRQ work involving foreign exchange concepts that were taught at the beginning part of the video. So that's a chance for you to practice and make sure that you have those skills really ironed out. Okay, so first off, let's think about international trade just a little bit. And I've got this circular diagram here, but we're only going to think about the top half of it, and really we have a simpler version on the next slide anyway. So let's think first about the fact that the United States and China are sort of different kinds of countries. We'll use China as an example for the rest of the world here. We buy a ton of goods from China. They buy some goods from the United States. And we pay tons of money to China for the tons of goods that we buy, and they pay a little bit of money for the little bit of goods that they buy. So on balance, we know some things about the United States as a net importer in its relationship with China. This is, of course, the subject of a lot of popular media coverage among politicians and things when you hear about trade deficits and so forth. We'll be able to work that in a little bit too. Okay, so these arrows and their width represent flows of money if they're green arrows, flows of goods and services if they're black arrows, and their width represents the proportion of those flows. So you can see here that's a big payment that the US makes to China right there, that big fat green arrow, in exchange for this big fat black arrow of Chinese goods. And if you look around your house for Chinese goods, I bet there's plenty of goods that are made in China, right? Okay, now China buys some goods from the United States, and that's this thin black line going over the top, but we knew that wasn't as many. And here's this thin green line coming back. That's Chinese payments for United States goods. So you can see sort of the bold label goes with the bold arrow and so forth. All that stuff is happening in the market for goods and services. And we'll think about some terminology for that, but that's basically what happens up here. Now, as a result of that, what happens is that we send dollars this way, and dollars keep building up over there in China. Now you might say, well, what can the Chinese do with those dollars? I suppose they could use some of them to buy American goods, but they're not going to use all of them because we already stipulated that we buy more from China than they buy from us. So that's where the bottom half of the diagram comes in, and this is where things get just a tiny bit more abstract. Okay, here the Chinese get to take advantage of those dollars by using them, sending them through markets for financial assets. That's what that bubble down there represents. Okay, and in the market for financial assets, what are we talking about here? Financial assets like stocks and bonds, let's think of. Okay, so I've had labels associated with stocks and bonds, but I suppose those aren't the only examples of financial assets. But let's think about those mostly. What do those represent? Well, stocks represent ownership of a small slice of an American corporation, and bonds represent debt, either government debt or corporate debt, right? A promise to pay. That's sort of thing too about bonds, is that they're a piece of paper that represents debt, right? Okay, so China buys a ton of American bonds. That's this big fat green arrow, and we send the bonds back. You can think of these as the pieces of paper, and this is the money. Remember, bonds are never money, right? Okay, and we buy, of course, some Chinese bonds and stocks, and that's this thin green line, and then we pay them for those. So just to simplify a little so that we can add some more labeling and some texture to this, let's have this same diagram, but now what I've done is gotten rid of the skinny arrows. So now we're just thinking about the net flows. We'll return to the top half, and we'll define a new term, the current account. And the current account for every country in the world is how much money is flowing into that country on net for goods and services. Well, we know in the case of China, it's this amount. That would really have been the fat green arrow minus the skinny green arrow, but that's the net inflow of payments to China. And this, of course, is the net outflow of goods, or the net inflow of goods to the United States. So the US has a net outflow of money. Well, how do we do this if it's an inflow? What we would then figure out is that China has a positive current account and the United States has a negative current account. What does it mean to have a negative current account? It means money's flowing out in the market for goods and services. I guess it means you're enjoying more imports than you are selling exports, and maybe that's a bad thing for considering that you have a trade deficit or something. But I suppose it's also a good thing in the sense that your consumers are able to enjoy a lot of forward goods. So I don't know that having a trade deficit is necessarily a bad condition. It's often painted that way in the media. But all it means is it's just a descriptor that says we are a net importer and our net exports, or X minus M, is negative. So that means M is bigger than X. You can conclude any one of those things, or excuse me, if you have any one of those things, you can conclude all of the rest of them. Those are functionally equivalent statements. All right, so then let's think, that's what's going on. All of the opposite of those things would be things you could conclude about China, at least in its relationship with the United States, probably the rest of the world. Okay, panning down to the bottom part of the diagram here again, we can think a little bit about these big Chinese payments for U.S. stocks and bonds, and that means there's an inflow of money down here through the financial market. Well, what is that called? That's called the financial account, and that's money flowing into a country through the market for financial assets like stocks and bonds. And so what can we conclude from all that? U.S. has a financial account that's positive, and that means we have an inflow of funds to the bottom half of the diagram, and China buys more of our financial assets than we do of theirs. What motivates people to do more of this over here? Why do we buy more goods from China than they do from us? Probably because we have a higher national income on average per capita, so it's more disposable income per consumer, and also probably because production costs and the price level are pretty low in China compared to the United States. So we buy goods from China because we're rich and because they make goods cheaply, because they have a low price level. And those things will become relevant when we think about the graphs on the next slide. Down here, what motivates people? Well, why would China buy lots of U.S. stocks and bonds? They have a lot of financial capital that they want to use to buy stuff later, and so they're seeking out high rates of return and stable investments. In other words, bonds from countries that are pretty certain to pay you back. Okay, and maybe it's the case that we offer higher real interest rates, or we have cheaper bonds. Remember, high interest rates and cheap bonds. The bottom half of this diagram has a ton to do with thing 3. In fact, all the things about bonds are pretty related to the bottom half of the diagram. Really, the bottom half of the diagram is a lot about bonds. Okay, so that's a bit about financial account and current account, and often you have to be able to conclude whether there was a debit or a credit to a country's financial or current account. You just remember that debits are money flowing out and credits are money flowing in to that country. All right, now here we're looking at foreign exchange graphs, and really for any pair of countries, the value of their currency on foreign markets is sort of determined by supply and demand principles in these foreign exchange graphs. And you should think of these as working in pairs, even though frequently a free response question, like we'll see in a second, will only ask you to draw one or the other. Okay, so let's think about sort of how that looks and works. Okay, all right, we're going to have the market for US dollars and the market for Canadian dollars over here. Okay, and just like in the market for apples or bananas, you would have market for apples up here, and then down at the bottom you would have quantity of apples, and you would have demand for apples and supply of apples. All of that is the same. So this matches this, matches this, matches the title at the top. The tricky bit that people usually have trouble with is over here. And let's think about the market for apples. You would say dollars per apple would be really what the price unit would be. $1 per apple, $2 per apple, $3 per apple, something like that. Well, here it's how many of the other thing, not apples, does it take to buy one apple? How many of the Canadian dollars does it take to buy one US dollar? So think of this vertical axis as the price of one US dollar expressed in terms of the other country's currency. Right here, this 1.25 means you'd have to take $1.25 of Canadian money to buy one American dollar. And if you think about the opposite case, that's just the reciprocal fraction. And so just as this is 5/4 of a Canadian dollar, this is 4/5 of an American dollar. This means you have to spend 80 cents of American money to buy one Canadian dollar. Those will always be reciprocals, which also tells you for sure you know whenever there's shifts that you should have upward movement on one graph and downward movement on another graph. In other words, put it this way, the exchange rate of one currency in terms of the other will increase, and the exchange rate of the second currency in terms of the first will decrease. It means one appreciated against the other, and the other depreciated against the one. So the next step is to think about what the lines on these graphs really represent. And let's think about this blue line first. That's people who are trying to get rid of American dollars. They're sellers of US dollars, and they're trying to sell those dollars for Canadian dollars. This line here represents people that want to buy US dollars, right? Now, why would people want to sell US dollars to get Canadian dollars? Maybe they're going to take a trip to Canada, right? Maybe they are somebody who sells Canadian goods in the United States, right? They end up getting dollars, but they have to buy those goods from Canadian producers, right? Maybe this line might represent Canadians that want to buy American goods or travel into the United States. This line might also represent Canadians that want to purchase American bonds, because Uncle Sam really only wants to borrow American dollars. Okay, so we had dollar sellers, and these are people trying to sell their dollars in order to get Canadian dollars. Well, guess what? Those are the same people as the Canadian dollar buyers. Because if you want to take a trip to Toronto, you're selling American dollars in order to buy Canadian dollars. So more Americans take trips to Toronto, that's what happens. Same thing with the red lines. So big principle of understanding here is that the red lines represent the same people and transactions. And just to refresh that one more time, the red lines here represent Canadians that want to buy American goods or Canadians that want to buy American bonds. The blue lines represent Americans that want to buy Canadian goods or Canadian bonds. So when you shift lines on these graphs, you shift them in the same direction, and you shift the opposite curve. So you shift supply on one graph and demand on the other graph. Or you shift demand on one graph and supply on the other graph. So you're shifting both red ones right, or you're shifting both blue ones right. Well, what are things that would cause those to change, right? Let's go ahead and shift the red lines to the right. Okay, let's think about that shift a little bit. So that would be an increase in demand for dollars and an increase in supply of Canadian dollars. Okay, well, here are 4 things that are categories of shifters, and we'll just apply those to the red lines shifting right. So every time we're going to think, and this might be a situation where we end up perhaps with, maybe $1.50 as being the exchange rate. That's the amount of Canadian money it takes to buy $1 here, and that would mean that right here we'd be down here at like what, 67 cents or something like that, right? Because it's 3 halves and 2/3 are sort of the reciprocals in play right here. So there's, roughly what we'd be talking about there, that kind of a shift. Well, if American goods got cheaper, Canadians would want to buy more American goods. Likewise, if Canadian goods got more expensive, so that's a change in the relative price level going on there. And in this case, this would be the US price level becomes relatively lower than the Canadian price level. What if it was just cooler to buy, American goods? Maybe there was a fad in Canada that people wanted to walk around with an American flag, something like that. Well, if U.S. goods got more popular, Canadians would supply more of their money to buy more of the American flag T-shirts or whatever, and then they'd run around and wear those. Right? Sort of hard to imagine, but maybe it would be the case. Okay, what about changes in national income? Let's say Canada got a lot richer. Let's say Canada had a big increase in real GDP, like national income, right? That means they have more money to spend. They're going to buy more things, and some of that means that they'll take a trip to New York to go see Hamilton, and some of that means that they'll go to an away game for the Maple Leafs when they play the Chicago Blackhawks and go shopping in Chicago or something like that. So these are all things that would be more supply of Canadian dollars and more demand for American dollars. So that's the third one there, and I've put an asterisk by the third and fourth ones because these are the ones that in my experience really trip up students a lot. Students have trouble connecting this one. The first 2 are very intuitive. The fourth one has a lot to do with bonds here. What if American real interest rates were a little higher than Canadian real interest rates? So now American bonds got cheaper. Well, Canadians would say, I want more of those. I want those cheap American bonds. And so you look down here and you say relative real interest rates. If American bonds got cheaper, which means the same thing as American real interest rates increase, Canadians with financial wealth would want to bring it to the United States to lend it here so that it would grow even faster. Okay? All right, so those are the big principles of how you do foreign exchange graphing. Frequently, a problem will only ask you to draw one of those, but you should always think and plan about both of them together so that and make sure that you label very carefully, particularly the y-axis, because those are the things students have screwed up a lot in the past. Okay, let's zoom in a little bit here and think about a couple of free response problems that maybe would be helpful to analyze so that you could have a sense of how will I end up using some of the knowledge that was presented a little bit earlier in the video. Okay, so here's a problem involving Japan, and the first question it asks is, how does an increase in Japan's budget deficit affect each of the following? Well, part A is really not so much about foreign exchange as it is a crowding out question. So you might think, well, hey, Japan's government needs to borrow. They're asking me about the effect on the real interest rate. I know that's the vertical axis in the loanable funds market. And so I might say that the budget deficit will increase the real interest rate because it shifts demand for loanable funds to the right when the government needs to borrow. You know that demand for loanable funds shifting right increases real interest rate in the loanable funds market. And what happens to private investment? Well, higher real interest rate discourages investment. Firms find it more expensive to borrow to buy the new pizza oven or to borrow to invest in new human capital for their workforce or something like that. All right, so here comes some foreign exchange parts of it. What about the market for the euro? And we think about how a change in real interest rate in Japan affects each of the following. And in this case, they've been really specific to tell us which graph to think about and which line to shift. So if you look for those hints, that would be really nice. If you even forgot how to label it, they kind of gave you a hint in part 2 there. So let's go ahead and set that up a little bit. We want to do a graph here of euros. It's going to be a little bit messy, but that's okay. So this is the market for euros. And what do we have here? We have the quantity of euros down here. Oh boy, that's not really working very well. That's terrible. So this is the quantity of euros. It's an E. And we have the supply of euros. And we graph out the demand for euros. And then we got to have the yen price of the euro. What does that mean? Well, that's really telling us how many yen does it take to buy 1 euro. That's the big idea there. All right. Now, what happened up here? We had a increase in the real interest rate in Japan. So that means Japanese bonds got cheaper. And Europeans are going to want to buy more of those cheaper Japanese bonds. So here's S2. Europeans supply more euros in order to buy more Japanese bonds. That would actually be an increase in demand for the yen. But we're thinking about the euro right now. So that means that we have to show over here a decrease in the price of 1 euro. And it's possible that before, I'm just going to make up some values here, they might be plausible, I don't know. Maybe before it took 150 yen to buy a euro, and now it only takes 125 yen to buy a euro. So that would be a decrease in the price of a euro. Look, lo and behold there, the euro has depreciated against the yen. Okay? To reverse the change in yen price of the euro, should the European Central Bank buy or sell euros in the foreign exchange market? So if we think about part C here, what are we going to say to that? Let's look at what happened to the euro. Did it get more expensive or did it get cheaper? The price of a euro went down. The price of bananas went down, so bananas got cheaper. So euros are cheaper, right? When you're confused about the currency, just substitute in some kind of fruit or, cheeseburgers or haircuts or whatever you want, and you can kind of figure out what's happening with that price of 1 euro. So euros got cheaper. The central bank wants to make them more expensive. They want to reverse that change. How do you make something more expensive? Buy it or sell it? Well, of course, the answer is to buy it because you increase demand for the euro. And if you increase demand for the euro, then you'll increase the price of a euro. So they're going to sort of shift this line so it comes in somewhere over here and intersects right about there. So they keep that price at 150. That's the big idea of that question. All right, so here's another one. I encourage you to maybe pause the video and see if you can work through it on your own. Take just a second. Okay, well, hopefully you've gotten a chance to do that, and we'll just talk through sort of what's going on here. For part A, they said that there was a decrease in inflation in the United States. So one way we could frame that is to say that South Korean goods are getting more expensive, and United States goods are not getting more expensive. Well, over time, South Koreans are going to say, hey, those American goods are much cheaper. So I think that means that South Koreans are going to want to buy more American goods, because their domestically produced goods will seem frustratingly expensive due to the increase in price level. Based on the change the United States exports in Part A, what will happen? Well, if the current account balance for the United States is 0, now will money be flowing into the United States or out? It's going to flow in because the South Koreans are going to have to spend money to have us send those goods to them. So that means this is going to move toward surplus. Remember, a surplus means there's a net inflow in the market for goods and services. A deficit would mean there was a net outflow of money in the market for goods and services. They told us it was balanced before. That's a nice simplifying assumption, even though the real world is probably not true, but we know that. Okay, so what will happen to U.S. GDP in the short run? Let's think about that. Well, we know the U.S. had an increase in exports. So I think we can kind of reason from an increase in X to what's X a part of? That would be a part of aggregate demand. So that would be an increase in AD. A little messy, but that's AD. And when AD increases, that means that real GDP will increase. Boom, right there. Okay? All right, the South Korean currency is the won. Draw a correctly labeled graph of the foreign exchange market for the dollar. Okay, so here's our graph. This is the market for dollars. So here's quantity of US dollars. Here's our supply. Oops, that's our demand curve actually, but we'll go ahead and make that demand for US dollars. I'm going to just use a U to shorten things here, but I would really probably like to write USD. There's supply of US dollars. Remember, this is the market for US dollars, right? And labeling is vital on these things because they know students will be confused. So they're really looking to see, can you do the labeling? What do we have up here? This is going to be the price of $1. So it's going to be won per dollar. Wow. Not very neat, but that's the idea, right? And it's possible that, at the beginning here, make up a value that's maybe hopefully plausible. There's like 1,000 won per US dollar at the beginning. Okay. So what happened now? Lower inflation in the United States. We're back to the same thing. South Koreans are sending money here because they want to buy American goods. What does it take to buy American goods? It takes American dollars. So there'll be an increased demand for the US dollar because there was an increase in demand for US goods. So there we go. We could shift that over. That's D2. I'll get back to labeling that in a second. Perhaps we've left ourselves maybe with like 1,100 won per dollar. Okay, so the dollar got more expensive. The dollar appreciated against the won. The won must have depreciated against the dollar, right? There we go. All right, here's a long question where part of it features some foreign exchange work. So I want you to go ahead and maybe pause it. You can think about the things I underlined in red. And if you only want to think about part F and G, then maybe thinking about that up arrow next to my, that I wrote in next to part E will help you. Okay, if you paused that and worked on it, then my hope is that you got up to here where you saw expansionary open market operation. You might have thought, okay, that means buy bonds. They're going to push down the federal funds rate and other interest rates, and that means there will be an increase in real GDP. Why? Well, that's the goal of expansionary policy: lower interest rates, stimulate more investment and interest-sensitive consumption, shift AD to the right, real GDP increases. That's the vision of expansionary policy in general. Okay, so part F now asks us, how will the change in real GDP? Well, we know U.S. real GDP increased. How will that affect demand for the Japanese yen? Americans are richer. What do richer people do? Richer people buy more things. And some of the things they buy are Hondas and Toyotas and sushi and Hello Kitty stuff. So there's a bunch of Japanese stuff that we're going to buy more of. And that means we're supplying more dollars and demanding more yen. So that would be an increase in the demand for yen. And then you just have to draw the graph for yen and shift demand to the right. And you know the value of 1 yen would have increased. Let's say maybe from a penny to a penny and a half, something like that. I think it's a yen is roughly a penny. Okay, so hopefully you can go back to the previous parts of the video if you want to know how to exactly set up that graph, but that's sort of the way you would reason through it. And they coached you really nicely into knowing whether you were going to shift demand or supply. Here's one last one. Feel free to pause it. Okay, assuming you did that, hopefully you got to the point here. You don't really necessarily need to think so much about this part up above D in order to really grasp part D, because D is sort of separate. They tell you the real interest rate in the Eurozone increases, and they're saying based on that change in the interest rate, what's going to happen? Well, that means European bonds got cheaper. They pay a higher rate of return, and by thing 3, that means the price of bonds is cheaper. So when European bonds are cheaper, people will want to buy more of them. So you would say in response to D1 that demand for the euro increases because Americans seek more European bonds because they have a higher rate of return, right? Their bonds are more desirable because they're cheaper. And when demand for the euro increases, the value of the euro increases. So that's what you're basically showing on your graph. It's a market for euros and a shift right, and your explanation is because Americans find European bonds more attractive now that they pay a higher real rate of return. If the current account balance is 0, how would that change in the value of the euro? Well, we know the euro appreciated. So what happens when a currency appreciates? Well, it's going to cost more more dollars to buy 1 euro. So German cars and French wine and so forth that cost a certain number of euros to produce, when you translate that product into US dollars, they're going to seem more expensive to American consumers. We're not going to buy as much French wine, and we're not going to buy as many German cars, and so less money flows out of the United States. If our current account was balanced before, now it will be in surplus. So a bit of a tricky part there with E when they're talking about the effects of appreciation and depreciation. And just to kind of tie this all together, let's give a quick thought to the effects of appreciation, just to summarize those. When a country's currency appreciates, what will happen? So if the US dollar appreciates, that means that our income buys us more foreign goods than it used to. Because we translate it into yen and euros and so forth, it becomes a bigger number. So that means we're going to buy more imports because they're going to feel relatively cheaper. If our dollar's stronger, we're going to travel internationally more, which is basically like buying imports. And it's going to be more expensive for foreigners to buy our goods and more expensive for foreigners to travel to the United States. So X will decrease and M will increase for the United States. And that means that our AD will shift to the left. So a weak currency moves your AD to the right, and a strong currency moves your AD to the left. Hopefully that's a helpful bit of clarification on foreign exchange, and I encourage you to kind of watch bits and pieces of it as you need to review what I think is a really tough macro topic. Good luck.